The VCs were not the idiots in this case. They are many times, but not in this case.
Hello and welcome to another episode of the BetaKit podcast. I am your host, Douglas Saltis. And again, we have what has become a monthly tradition, our AMA episode, whereby we convince a special guest to come on the podcast and answer all the questions that we are completely unable to. This month, we have a very special guest, one John Ruffolo, founder and managing partner at Maverix Private Equity. And boy, howdy, were you excited to have him on the podcast, because normally we look to have a guest answer the questions that we possibly can't. I think these questions were built in the lab specifically for you, sir, based upon your lifetime of experience. So I'm just going to jump right into it, because this is probably the question we got the most from a bunch of different sources in a bunch of different ways. I'm going to ask the funniest version of this question that we got.
Okay.
And then we can talk about the more general subject, because I know you and I have been sending a couple texts about this in the last month. And I think my team even interviewed about it. Here's the question that we received. And of course, as indicative of our AMA podcasts, this was sent anonymously. Can you ask John to explain why a few high-profile American VCs triggered a run on Silicon Valley Bank? Which we can start there, and then I think go into your thoughts on the broader SVB circumstance. But I know we were texting about this in real time. It seemed like everyone in tech was watching this. Well, it wasn't really a slow car crash. It was actually happened pretty suddenly.
Yes, it was a sudden car crash that was completely not unexpected, but the speed of it was unexpected. So let me answer that question kind of in a two-parter, so to give a little bit of context. So number one, the cause that ultimately led to the run was a broken balance sheet. And it was beyond me that this could even happen with an organization that you thought should have been sophisticated. So to overly summarize for those who were not aware, Silicon Valley Bank had, give or take, about $200 billion of deposits that accumulated quite rapidly during COVID. And once COVID was over, they knowingly knew that the deposits would start to get chewed away, and relatively rapidly. They also knew that interest rates would be on the rise. So they did something very good. They said, interest rates go up, the ability of our customers ultimately to repay is going to probably go down. So slow down the loan book. What that did, it created a situation of massive excess deposits that they didn't really need to use to lend against. And what did they do? They invested these deposits, and they took $91 billion and they put it into 10-year illiquid, largely mortgage-backed securities that were averaging a 1.6% interest rate. Now, they said, or the CEO said, that they were betting that the interest rates would not go up that high, but I don't know what they were thinking. Number two, they were betting on an inverted yield curve where the long-term interest rates would actually be lower than the short-term. It was just a terrible, obvious bet, and you don't do that because you get a mismatch of your assets and liabilities.
Let's even hold on that when you're talking about the mismatch, because I think everyone, even podcast hosts, have been able to follow you up to this point. Banks takes deposits. They need to do something with that money to make a return, because otherwise having deposits in their bank costs them money. And they chose a long-term, very safe, low yields.
High quality.
Which is very different from, people have been drawing comparisons to 2008.
Zero similarity. Correct.
But the bet that they made that was mismatched is that they locked up a large portion of capital for 10 years at a low return at an interest rate that I think people would love to see right about now at a time when interest rates have skyrocketed relative to the last 10 years.
Right. And what the mismatch would be is, generally speaking, you want to make sure that if they didn't deposit the money, they're looking at an interest rate net spread, usually about 200 basis points. When you invest the money at 1.6%, and those deposits made by the depositors would start to attract ever increasing higher interest rates. And what was happening, they were paying interest greater than 1.6%. They had negative spread. And that's the problem. And the amazing thing, and I was at a conference with the CEO when he was speaking at a panel after me, and I wanted to chat with him. I've known Greg for 25 years, and I was going to ask him, hey, was this article by the Financial Times accurate? Because I don't understand it.
What's the timeline here? Remind everyone where you at this event, because
that's right. This was the bizarre thing. So the timeline started February 22nd article, Financial Times. I read that. Shocked by the article, thought for sure it was wrong. A week later, I'm in LA speaking at the Upfront Summit, and I'm speaking on a venture panel, and he is 2 panels after me. And I'm waiting. I go out and I want to hear him because I figured the interviewer is going to ask this question. Was this bet actually accurate? And did you really have a mark-to-market loss of $15 billion in less than a year? Because certainly you can't be that stupid. Well, he admitted it. He says, yes, it's accurate. I nearly fell off my chair. The next question made me appalled, though. The interviewer said, well, aren't you going to have a liquidity issue? And he said, no, we don't have a real loss because we're going to hold to maturity. And it's like, dude, no one's talking about the principal amount of the equity. We're talking about the negative spread. And also, your deposits are going down. How are you going to give it back? And when he gave, it was the response. And I turned to one of my limited partners who was with me. I will say a senior executive at one of Canada's big 5 banks. And I turned to him and said, did he just say that? And we both said, perhaps a little bit too loud, oh my God, this bank's going to go down.
That's an incredible story. But I think it sets the context in which, as people were becoming aware of this, the fortunes that SVB was facing. And for us, tracking this in our little corner of the financial markets world, which is like the smallest corner, I think it really came to a head. And I want to tie this to what you're saying about the poor answer that SVB CEO is giving when they were making kind of the announcement that they were looking to raise additional capital to cover things. Because at this point, hey, okay, we made a long-term bet at low returns. We're in a different market right now. We've got to cover this liquidity gap.
Correct. As deposits are getting chewed through.
Yes. And it seemed to me, and I think this gets back to our original anonymous question about what triggered the actual run, that had they raised the money and announced it, everyone would have been like, times are tough for everybody.
Correct.
Glad they've got things covered. They seemed to announce this prior to closing the financing, as their share price was already beginning to slide. And I think there was that fateful Wednesday or Thursday afternoon conference call with a variety of Silicon Valley investors and some of their depositors that seemed to not reassure anyone. So would you say that this was triggered by a few high-profile American VCs saying, we need to get our startups and our money out of this bank? Or was it literally just like, we don't have any faith in the person running this right now? This was not George Bailey.
Yeah. So it's a bit of a complex question, but I'll give you my simple conclusion was the VCs were not the idiots in this case. They are many times, but not in this case. Silicon Valley Bank is solely to blame for their stupidity and the way that they handled it when the market started to really get a hold of it. Now, in terms of the VCs, some of the VCs actually were already quietly encouraging their portfolio companies to get out of Silicon Valley Bank, which started exasperating the decrease in the deposits. Like, I don't think you can judge folks that make a decision based on what they think is good for their portfolio company. And there were also VCs, and again, one of my close friends is Mark Suster at that same Upfront, he's the host of the Upfront Summit, that was saying the opposite, hold the money in. And either choice is very valid. The problem that I had is there were a number of VCs who were very public on social media, particularly Twitter, praising and professing their undying love for SVB. And then behind the scenes, I was fully aware that they were telling their portfolio companies to get out.
Do you want to name any of those investors?
No, I will not. But those are the scumbags, because yelling fire in a crowded movie theater so that they can watch the rest of the movie in peace. It was ridiculous. And it gives the VCs really a bad name, and they already have one, generally speaking. But I thought it was unconscionable. And when I'm speaking to a number of the folks, whether it's SVB directly in the US, my buddies over there, they knew exactly who was doing that. That is the problem that I thought was rather unconscionable. And they're acting rather smug. Well, they got their money out, and yeah, they had to do some dirty work, but that's despicable.
So what is your take then? Like, obviously this was exacerbated by, 50% of US startups were banking with SVB, and obviously their investors, usually both their deposits, but their venture debt, and even some personal mortgages, because SVB was the only bank that really catered to an environment of businesses that can't get either the same terms or any terms at other more traditional banks. Obviously, there was a close concentration here, some network effects in terms of the target demographic, and a demographic of people that are highly networked in the first place. So there were obviously going to be group threads that you and I were in, sharing this information and maybe leading to a bit of groupthink. How much would you weight that rational actor groupthink of everyone coming to the same conclusion or sharing information and doing what was best possibly for their company in those circumstances when you're staring down the barrel of payroll and 100% of your holdings are in one bank that doesn't look that stable? And how much would you attribute to that other class of individuals, those few high-profile American VCs, maybe those people that were saying one thing publicly and another thing privately, to tip the tower over a little bit? Do you feel that this was just a fact that, like, if this were a demographic of other groups of business people in North America, that it wouldn't have happened so fast, but because it was the Valley, everyone was messaging everyone?
Yeah, I do think so. There was a few high-profile VCs that came out very early. People refer to Peter Thiel as probably being the most influential. Again, I don't judge him for his conclusion. Peter Thiel has a lot of followers, and the technology network is very, very incestuous. It's very closed loop. Frankly, one of the biggest criticisms of VCs is that they all act like sheep and they all move in the same direction. Well, it cuts both ways. So I do think that this is the first example of a bank run done by virtue of Twitter. And that's the part that surprised me. So remember when I said on March 1, I knew this bank was going to go down? And then you might ask me, John, did you short it? I said, damn, I didn't short the stock. But you know why? Other than the fact I didn't think about it. I was really thinking it was going to go down in about 6 months. I didn't think it was going to go down with the lightning speed. So I would say the bank run was going to happen, but the shocking speed was really done by virtue of the closed community and on social media.
So it's, once again, Twitter's fault. Understandable.
Look at that. Elon, who would have thought Elon would have caused a bank run? Jesus Christ.
Okay, so there's an obvious follow-up to this question, and I want to make sure we ask, to tie this to Canadian tech and tech from a Canadian perspective. Obviously, we're seeing what's happening to SVB Canada. Like, it's done. It was interesting to me tracking this, that the fears in the U.S. market were one of, if the 15th largest bank in the United States can go down in a week because of Elon and Twitter, how much risk are the vast network of smaller banks in the US? And might we see a consolidation amongst the top 5 banks in the United States? How horrible would that be? From a Canadian perspective, that's like, well, that's our everyday. We have 5 banks. And from a Canadian venture and technology standpoint, while SVB Canada didn't have a banking license, which, depending on how you look at it, might be a blessing in disguise right now, but we certainly lost one of our venture debt lenders in this market. What do you think about the conflicting viewpoints of competition here, and what the lack of an SVB Canada in the venture debt market is going to do to, I wouldn't say as shaky a Canadian market, but obviously one that is smaller and vulnerable?
Yeah, so I think the difference is, in speaking specifically on the venture debt, so they had the second biggest market share in Canada, far behind CIBC Innovation. If you asked me this question 10 years ago, it would have been devastating impact to Canada because they were such the disproportionate big dog. It's no longer the case. And then after CIBC, you have RBCX and you have BMO really coming up very, very strong and being very aggressive. And so the competition for the space amongst the big banks is very, very different. And they would be able to easily soak up the $400 million or so of venture debt out there without blinking an eyelash. So in terms of the short-term impact, I would say it's likely negligible. The question that I have, and the question that I posed, and I think you and I were talking on the Friday, and I was speaking to 3 of the 5 big bank CEOs, and I raised this question. I said, I got a concern with you guys. Every time, at least in my history, a formidable competitor who kept pricing honest goes away, you somehow go back to your old ways. Are you going to do this again? And I did get the same response by all 3, which was, hey, we're in competition, a fierce competition amongst the big 5 banks for the same client. So they said that they don't them getting lazy and increasing pricing. And I said, okay, guys, but I'm going to call you out on that if we see that. And they said, fine. And I reported that into all the interviews that I did. I kept on making that same statement because I was serious to the folks. This will be the issue. And it's not even so much the pricing, it's the adjudication of the loans. This is where SVB was very, very good. And again, CIBC Innovation learned only through the acquisition of Wellington and got Mark McQueen in there. Otherwise,
who is now no longer running CIBC Innovation Banking.
Right, but Mark Usher is there. Mark is very, very strong. Has been in the space for many years as well. So I have great comfort in there. So I would say long-term impact. I hope that we don't see the space getting tougher. But when you hear people saying, "Oh, yeah, we have a lack of capital," like, ignore SVB. The issue on the lack of capital or decreasing amount of availability of capital was already occurring by virtue of the crash in valuations. So it was just coincidental that SVB happened to crash in and around the same time.
Let's take this from a different track then. If the big 5 banks are personally committing to you that they are going to compete and offer similar or fair terms to this demographic, I'm wondering if there's another question here is, with everything that's going on in, let's say, global venture and this sector, do you foresee an instance whereby these banks lose interest in servicing this demographic? Because I think that's a consideration. It wasn't just Wellington and SVB competing on terms. It's that they actually created a book of business that serviced venture-backed startups. And I would say that there's a part of the reason why we got a little lucky that SVB Canada had a banking license, there's a counterpoint there, is that there's a lot of Canadian businesses that are very frustrated because they can't get favorable banking terms in the way that U.S. businesses, or they were able to in the U.S. with U.S. accounts. Do you foresee maybe a movement away from this sector, from the big five banks? Because it's significant, obviously, for the purposes of this podcast, but relative to what else they have going on, it's kind of a drop in the bucket.
Yeah, but two part of that question. I hope that the banks don't lose interest in the technology sector if it goes through the doldrums like it did post the .com bust. And that's always a concern. That are they really tourists or are they committed to the space? Again, they would say that they're committed, to.
Is Sid Paquette a tourist?
Yeah, see, I don't think Sid's a tourist. That's exactly right. I mean, I hope not, because then there will be no more RBCX. And, you see the difference. You have CIBC Innovation. They want to grow their book from $2 to $10 billion over the next 10 years. Like, they really are making big investments. These are numbers that I haven't, seen before. Now, if you're a Canadian technology company, not getting your business from one of the big banks, at least today, is going to be rather difficult. One of the problems that SVB had in competing against the banks is that the banks were increasingly lumping all of their services to a particular client and saying, hey, we're going to give you this really, really cheap pricing, but you better have your credit card processing with us, your deposits, blah, 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 so we can make the math work. So if another competitor comes into the Canadian market and doesn't have the array of services, it's very difficult. And SVB, the sole reason why they were looking at the deposit or the Schedule 1 bank license was so that they could take deposits to decrease the cost of their loans, because they were getting hit pretty hard by the competition. So I do think that deposit taking is a massive structural advantage if you're going to play in Canada.
Okay. Well, maybe one additional follow-up on this, and then we'll move on to the additional questions we received. We've been hearing a lot from our friends at the various surviving innovation banks in Canada that they have been just overwhelmed. Like, they haven't been aggressive so much as overwhelmed with interest of Canadian businesses looking to move off of SVB. Obviously, SVB Canada is going through a process with Canadian regulators to do an asset sale. Everything that we've heard is that there is little interest from the innovation banks to buy those assets, because it seems much more feasible, because there are no deposits for them to take with them, that they are just doing net new deals with these businesses so that those businesses can buy out their old loan with SVB. Any word of advice to founders looking to kind of negotiate that process, knowing that they're now looking to secure an additional loan in a very different environment to pay off the original loan that they took with a bank that no longer exists? Any guidance you could give to founders there in terms of how they navigate that?
Now, first of all, First Citizens Bank is now confirming whether they have the option to buy the Canadian loan book. So I don't know what the time frame is, but I assume it's going to be imminent. But if not, I do see the possibility of one of the Canadian banks buying the loan book. There's 2 of the 5 banks have significant excess deposits. So this is easy money for them. The 2 banks being RBC and TD, because of the excess. They would make the most sense. The other 3 banks are currently borrowing money on a wholesale basis, on a daily basis, in order to satisfy their lending activities. It would be a little bit more expensive for them to do that. But again, I think that the quality of the loan book in Canada, my hunch is it's very high quality. So I think somebody would grab that. So I guess the question is, unless you are having massive anxiety, I would just sit tight and wait to see exactly what's going to happen. So I think it's going to happen very, very quickly.
Okay. I think that's going to be the extent of our SVB content. was a good 30 minutes, but I know we had several questions related to that.
Sure.
And it's worth getting, obviously we've had you quoted in a variety of stories I've been writing about this, but kind of more as the dust has settled, fulsomely talking through these considerations. It's obviously prompting and triggering a lot of questions about Canadian venture overall right now. I'm going to go to two from Eric Kreisky, I believe the co-founder of Bedali. And I'll go to the first one that most directly connects. In light of what's happening in the US regarding the banking blowups and just general geopolitical conflict, does John think that Canada's cultural risk aversion is a bug or a feature? And I know that that's been in 2008, like we just haven't had a bank fail in the last 2 centuries. I'm just wondering if your thoughts here, you've obviously been very strong about the benefits of Canada and Canadian innovation, as well as poking at some of the limitations and how we need to more compete globally. This is that old bugaboo of like Canada is risk averse and sometimes that works out for us. Where are you on the bug versus feature kind of side?
Well, I actually just don't buy about the risk aversion, but it depends on who you're talking about. If you're talking about the entrepreneurs, I put up Canadian entrepreneurs up against any entrepreneurs. I've worked with so many of them around the world that I don't see a particular difference. One might argue that in Silicon Valley, very specifically, due to the availability of capital, that they could give the impression that they have a greater risk appetite. But in the era of cheap money, that was easy to do. Let's see what happens now. So I don't think that statement is correct. However, if he's referring to the risk aversion of Canadian venture capital, I think he has a very fair point. To give Canadian VCs the benefit of the doubt, you could say, well, they're more conservative because the availability of capital to them is so far less that they have to be so much more cautious in terms of their portfolio construction. But, and that's the positive view. I'd say the negative view is there's some good exception, but there is a difference in behavior, I would say, on Canadian VCs with US VCs as a very general comment.
Yeah. If you're looking for specifics on that type of general comment, let me point you to the Renault Run story that the Globe and Mail just recently published.
Yeah, it was a tragedy.
I don't want to talk too much about that because we've been working to drop our own story, which I think will move that forward a little bit. But let's put a pin on Eric's question for a minute because he did have a follow-up here. But what you're leading to, it's almost like we shared these questions with you in advance, which we absolutely didn't do because I pulled them together right before we started recording.
That's right.
This one is from James Shower, who I actually worked with a million years ago at Research in Motion. He asked this question. Usually there is a risk delta between the US and everyone else in terms of the kinds of risk that private equity or venture is willing to take, particularly with respects to time to market in the early stages. He notes that Figma and Airtable both took several years to have public products. Has the 2022 downturn changed that equation? Are Canadian investors really backing off, or are they still going head on?
I would say, again, when your availability of capital is so much less than it would be compared to I'd say a top tier US VC firm, your ability to make that long-term bet is very, very difficult. It's not an excuse, but it is an impact. If you were to stratify the US firms of similar size to the Canadian firms, the behavior is not different at all. You cannot see it. The problem is some of those firms where they had this long bet in there, they were funded by very large US VCs who have had a series of funds and were able to play those very long-term bets. The only place that you can get the Canadian equivalent of that behavior is through a Canadian pension fund, which is the reason why I built Omer's Ventures, because it was the only place that I could see in Canada to actually place those long-term capital bets.
Mm-hmm. But, do we want to dig into that a little bit? Because obviously you're no longer at OMERS, you aren't running their venture capital division, but you've also positioned yourself with Maverix in a very interesting place where, and we've written about this quite extensively on BetaKit, so make sure to check that out. It's Maverix with an X, by the way, if you're going to search it.
Yes, it is.
That you've kind of positioned yourself between, right sandwiched in the middle, where I think you've attributed the opportunity lies between venture capital investments and then traditional PE, which usually comes in late and heavy and hard. And you're looking a little bit more opportunistic at that transition period to, not to speak for you, maybe fill some of the gaps that you're noting in a very small Canadian market. Do you feel like the pension funds currently are as well positioned to kind of handle this market right now in Canada?
Well, the problem in the pension funds, I can't speak to all of them. I can only speak to my own experience. The long-term capital pool advantage is definitely there, but I would say is theoretical because management changes all the time, objectives change. When I was constructing the first fund for OMERS Ventures, and the first few bets were very, very early bets, like wave accounting was the very first bet. And a few of those were similar, but I was getting very deeply concerned that here I am building this with this advantage of the long-term capital pool. And then lo and behold, I started getting pressure of, so, by year 3, you better have all of what are your financial indicators of success? And I'm looking at them going, are you kidding me? 3 years? So when you started to see there was a modification in the strategy where I started doing series A, B, and C and mixing them on a portfolio basis, it was designed to flatten the J curve impact so that I could have some earlier returns so that I don't get the pressure of the short-termism that I wasn't expecting, to be honest.
So to maybe tie this back to what we were discussing before, would you say that the Canadian innovation banks and the Canadian Big Five banks in general are a little bit more committed to this demographic right now than potentially the pension funds are when it comes to long-term commitments to Canadian venture and Canadian innovation?
Well, let me say this a different way. The 3 pension funds that have deployed the most capital directly in the space is CDPQ, Teachers, and OMERS. And again, I don't have detailed information, but I could just give you a general perspective. They all seem to really double down and triple down at the exact wrong time between 2019 and 2021, which is the exact same time that I was pulling out because you can see the wreckage.
I believe there's a close proximity to us writing stories about the launch of Maverix at the exact same time that Teachers was promoting some new hires and promotions and basically saying we are investing in. And there's no shade there. We're literally just noting that was
it was true. It was in my white paper of the crash that was going to happen. I was predicting it in the second half of 2020. I didn't predict COVID, but your entry point is very critical. Why is this an important comment? The same thing happened 2 decades ago, and then there is annihilation. And then what happens, people start to have, recency bias. And where I get very concerned is, do some of the pension funds start to go, oh my God, we just got nailed with a bloodbath. And, are we just better off going into more predictable, steady Eddie cash flow type businesses? That would be the wrong reaction because yes, was your timing poor? Yes, it was. Shame on you. But it doesn't mean you run the other way. Now is the time to be investing your capital. But it is funny. People tend to do the opposite thing. They sell low and buy high.
Okay. I think there's more that we can kind of discuss on this point, but we've got to pay some bills on the BetaKit end. So I want to note here that the BetaKit podcast is sponsored by Osler, Hoskin, and Harcourt, LLP. Now, Osler is the leading business law firm for startups, high-growth companies, and investors in Canada. For the second year, the firm has released the Deal Points Report, Venture Capital Financing, a study of 353 anonymized Canadian venture capital and growth equity financings. The report looks at deals from 2020 to 2022 valued at more than $6 billion USD and provides data and insights for founders, entrepreneurs, investors, and advisors contemplating transactions. Now, the report draws on publicly available data on venture capital and growth equity financings, as well as Osler's confidential, anonymized data sources. You can read the Deal Points report, Venture Capital Financings, at osler.com. Tell them BetaKit sent you. Okay, maybe let's bring this back to our friend Eric, co-founder of Bedali, and one of the other questions that he's had, because I think we're connecting tangents here. Eric asked this question. He's wondering if you think that Canada's tech ecosystem is how it is positioned within this macro geopolitical and contracting VC environment. So we've been talking about the pension funds, we've been talking about the innovation banks, we've been talking about maybe the position that some startups are in. Overall health metric, where do you feel that we are relative to what we've been seeing in the United States, or just historically here? Because again, we've been, for our own context, and we can link to this, we've been doing our quarterly annual briefed in reports where we're tracking, 2022 was a pretty down year, as long as you compare it to the 2 years prior. If you compare it to 2019, it's still a significant increase and continuing the trend line of the last 10 years of this tech ecosystem. So I know we've been kind of question by question attacking different components of our ecosystem and what pivot points or leverage they might be feeling. How do you feel just about the overall ecosystem? Do you look at it that way, or do you more look at it as the individual components? Can you kind of get a holistic health?
Yeah, I would say that the long-term health and optimism is very high, largely because unlike 20 years ago, when people didn't understand the power of technology and the impact, that every business will be a technology business. And I think that truth is coming to fruition more and more every day. So it's not turning back the other way. So I would say that directionally it will continue to be the place to bet on for sure. I'm betting my entire career on that.
Same.
Now, short term, what's going to happen? We've gone through 3 years of this over exuberance and these declaration of unicorns, 98% of which never really existed. And the impact of those decisions are going to be felt for the next few years. So I'd say in the short term, we're going to see decreasing capital deployment, and it usually lasts for about a 3-year lag effect. This is the same thing that happened, after the post .com crash. The difference, I hope, and I'm going to bet on, so in 2005 was actually when the market bottomed out, even though it crashed in 2001. The problem was it went below a minimum level before it couldn't resurrect itself without government or some other intervention. We're not at the same position. So I think for the next few years, we will continue to have some challenges. But I also think we're going to go on to our next big technology cycles. And so investing, particularly at the seed and pre-seed levels, I think is going to be relatively attractive because their horizon is much longer.
And they're not currently dealing with the valuation issues that every company that
They never really were. They were to some extent, but they were probably at worst 2x too high. When you got to the late stage of venture investing, anyway, it was ridiculous.
Okay, well, you are essentially a mind reader, because this leads very well into our next question. This came from Graham Moffat, who is an OCI board member. He's a U of T Monk School senior fellow, I believe. He is very online. You can read his tweets. He wanted to first say hi, and then he wanted me to ask you how Canada becomes less dependent on state support for venture capital, or whether it's still too early to think about that problem yet. And noting what you said previously about us not being in a flywheel position, 10, 15, 20 years ago for this industry to be self-sustaining. Where are we at now? Because there's been a variety of drums that have been banged by the CVCA, Communitech, other organizations, particularly in light of what happened to SVB, about the dramatic need to accelerate the deployment of capital. We had Kim Furlong on the podcast, I think, to close out the year of 2022, talking just about the state of venture, but then also some of the comments that she had made related to VCCI, the Venture Capital Catalyst Initiative. Where are you on this component of state support, acknowledging what we were just talking about in terms of the target market for Canadian venture being very early, and then maybe a wavering interest or a poorly timed acceleration from the large pension funds that are able to sustain this? And then I guess to tie it back, that third component, a lot of the in-between funds who have been looking really hard for additional government supported funding to raise new funds, or are looking at their books and saying, man, we are marking down a lot of venture investments right now because we did chase crazy 100x valuations on revenue type scenarios, to the rental run specific.
Yeah, no, this is a multiple layer problem. Let me try to oversimplify this. So
Please.
I was involved in the very first one. So I actually crafted in 2009 the original Venture Capital Action Plan when I was leading the CVCA's Government Relations Committee. We based it off of the YASMA model in Israel. And when I first proposed it, I got a visceral reaction back from VCs at the time. I was a partner at Deloitte, and they were going, oh, we don't need government. We can do it on our own. I'm like, yeah, really? Well, my clients say, no, you can't. And so we needed the government to give it a one-time shot of adrenaline. And everyone said, yeah, we need this one-time shot to give us some necessary capital to match or to increase the amount of capital so that we can do the proper portfolio construction decisions. So for example, if they could raise $100 million by conventional sources, but if they had an extra 50, this was the argument, then everything's great. Well, what started to happen is there was a bunch of VC firms that the majority of their capital came directly or indirectly through government sources, largely through the venture capital program.
I'm assuming you're probably talking about indirect fund of funds through VCAP or Vicky, and
yes.
But their co-LPs in that are either provincially backed funds or BDC or something like that.
Or you have 4 fund of funds that are carrying out the mandates, and they're all co-investing with one another, right? Well, so now you're getting into a perverse situation. So let's just argue that ultimately, so let's just say you have a VC fund that has 4 backers, and this is an example, that they're backed by Northleaf, Kensington, Terralist, and HarborVest, $25 million each. And then what happens is that VC fund is now competing to invest in a technology company, and they're competing against another Canadian VC that has the same 4 backers. And they're increasing the price to one another because they want to compete to win. It's like, wait a minute, the exact same pool of capital is artificially increasing the prices.
And not necessarily creating competition, because we're so small that everyone's in everyone else's deals, which is why most of my conversations with Canadian VCs happen in DMs on background or off the record, because no one is willing to publicly say something that might impact the 6 or 7 other deals that they're in with the same people.
Correct. And so the problem is, so then when there was Vicky or then the venture capital second one, it was like, you know what? Yeah, we said a one-time shot of adrenaline, but we really need 2. And, now we really need 3. It's like, hold on.
It was always a 3-time shot of adrenaline.
Yeah, yes. Now it's like, okay, when you guys got to get off the teat of the taxpayer, make money. And at the end of the day, you're going to have to prove it by making money. And the pension funds are not stupid. If they believe they can make a 2 or 3x times return on your fund, they're going to do it all the time. But I know there's arguments that the availability of capital in Canada is a smaller and it's a shrinking pool of doors to knock on. I get it. But that means you're going to have to go to non-Canadian sources and convince them that Canada is a good place to invest in. Is it harder? Absolutely it is. But raising money for a fund is really, really hard. And most people can't do it. So that's why there's so few funds. So I would just say the venture ecosystem is never going to get to the right level of maturity if they don't constantly rely upon the taxpayer to provide them with the capital. If that's the only solution, then we should just have one crown corporation to make all direct investments across the country and everybody hang up their shingles, which would be,
this wasn't planned in any way, but we literally just had Michelle Scarborough on the podcast last week talking about $500 million committed through Thrive to indirect and direct investing in women-led startups and funds. It's worthy to note that's a very different consideration, predominantly because they're looking to expand the pie of people who can make investments as well as who are being invested in. So I almost feel like we're kind of at that point, though, because, BDC is also an LP in a variety of other funds. They help oversee the deployment of a VCCI. This became a really VCCI heavy in the weeds thing. So I want to get back to Graham's question then, because it seems like you feel that it is not too early to think about this as a problem based upon what you're saying.
Yes.
But how does Canada then become less dependent? Is it just looking to raising money from other sources internationally? Are there pools of capital in Canada that have traditionally not participated in venture that should be stepping up here?
Well, so for Maverix, I made 700 calls in Canada. I spent, in some cases, 25 to 30 years developing relationships to build trust on some of these organizations. It's not easy. For you to just come in and thinking that somebody owes it to you to hand them money is ridiculous.
Mm-hmm. And you went kind of underground for like a year and a half.
I did. Well, yeah. Mine's a different saga. I thought I had it raised and then unraised. COVID hits. I get run over by a vehicle. But despite all of that, I still was only about 3 months later than I thought I was going to be, funny enough. But even, when I'm looking towards my next fund, I am going to the U.S. to help diversify my LP base and doing it in a very logical fashion. And then after I go to the United States, maybe Fund 3 is going to be Middle East. Maybe it's going to be Asia. I don't know yet. But I'm not leaving it just to the Canadian LP base, which my investors have been unbelievably to me, and I will never forget them, and I hope they'll be loyal to me all the time. But make no mistake, they've invested in me on the presumption I'm going to make them the money that I said I was going to do, and I think about it on a daily basis.
Okay. Let's continue this thread, but take it down a slightly different angle, because we're talking about government's involvement in our ecosystem, which I think most Canadians are generally comfortable with crown corporations and government involvement at certain points. We're at a very interesting time, though, right now, and this has been the heavy focus of the podcast we've been recording this year, where there are 3 bills currently moving through Parliament that fundamentally have the opportunity or will certainly change Canadians' relationship to the internet. Bill C-11, Bill C-18, Bill C-27. This question actually came in for our last AMA, but we couldn't get it in time, so we're saving it for you. And given your perspective on these things, I think you're the perfect person to answer it. There seems to be a trend of regulatory capture in Canada. See the CRTC and the CTA. Let's say Bill C-27 passes, as is, and ADA gives us a new AI and data commission. What are the risks of regulatory capture here? Is Canada's AI academic community fit to support a strong, independent regulator? Are there any Canadian companies you would expect to see helping a regulator or lobbying or supplying executives to, etc.? Or will it largely be the usual heavy hitters, Google, Microsoft, etc.? I think probably the caveat I will note here on your behalf is that not only are you the founder and managing partner of Maverix, You are also, I think, a co-chair and founder of the Canadian Council of Innovators, which is essentially a lobbyist organization focused on broadly, let's say, everything we've been talking about today. So I think you have a particular set of people you might know that would be participating in that kind of conversation.
We are heavily involved in those conversations. And a few things are at play. And by the way, if any of your listeners want to know more and get involved more, Ben Bergen at CCI would be pleased to engage with stakeholders. But
we keep asking him to come back on the podcast, and he's never in Canada. So we're just waiting for him to touch base.
Number one, we are boldly pro-Canadian companies. It's not being nationalistic. We're not saying foreign companies are not welcome. However, we designed our organization to support Canadian-based innovation. It's designed to maintain the ownership of data and IP in Canadian hands, particularly if there is taxpayer support of any kind. The other thing that is happening is the regulation around the world has been very, very strong. And the two, I'd say, leading influences, Europe, number one, have probably been on the front end of every single one of these issues. And it then comes across the pond. And then the United States is there, and they're trying to swat away the European regulation. And the European regulation is forcing the Americans to move. And when the Americans move, they want to move with global dominance, which means that US-based companies would have the complete freedom to operate also in Canada, but the rules in the United States would be tilted in their favor against Canadian companies. So what we're trying to do with the various legislation is, knowing that legislation is coming, and you're not going to get around regulation. And we'll start off with, I don't like regulation of any kind, but when you know that it's needed so that the ground rules are clear, create the Canadian standards first that we agree with. And then when we are discussing these issues on bilateral trade agreements that go on constantly all the time, we are prepared in Canada to defend our sovereignty around these various issues. And we saw when we were unprepared, like the Trans-Pacific Partnership, where Canada was completely laid aside and the rules were all stacked against Canada. We're trying to avoid this situation so that our Canadian companies can effectively compete not only in Canada, but have a good chance from a global perspective.
Are you saying that at a certain point, regulatory capture is a given now based upon what we're seeing in Europe and the US? And it's just a matter
is a matter of time. So you're going to have to get on it and hopefully craft the rules and take control of the narrative, because it's going to run away from you. So yes, that's the short answer.
I don't want to get you in trouble here, because I know you've been testifying before some certain committees. And if we go too far, Ben's going to send me an email or call me. But I want to maybe ladder this back up to a higher level, not with this bill specifically, but the federal government's approach to be wading into these waters by necessity. Beyond Bill C-27, we have C-11 and C-18, which we are on the record, and I encourage everyone to check out our podcast with Senator Colin Deacon and Rain Maida of Our Lady Peace, talking about some of the issues that digital content creators, including, let's say, news publishers like BetaKit, are facing, but then the difficulties that our Canadian legislative body is facing, and what I truly feel is an attack on our sovereignty by big global tech, basically trying to exert their leverage to prevent Canada from having not just regulatory capture, just base level regulation as it might pertain to creating a space online for our culture and our creators, and any sort of support of a very tired, distressed Canadian news industry. I'm wondering, I'll also say, just for your benefit, John, that I'm also very much against both those bills for very specific reasons. I don't think that they're very well constructed, but I think the overall intention here is something that we should be reclaiming. I'm wondering how you just feel about that process, because I think most people who are not you in Canadian tech see a government as purely a bureaucratic process inhibiting the direct innovation magic that happens in garages and co-working spaces. You play at a higher level than that. My old boss, Jim Balsillie, plays at a higher level than that because he's experienced these things. There seems to be an understanding that there's a necessity to engage at a policy level on these things. I'm just wondering what your thoughts are on, or you could say something to my audience about the necessity for there to be some equilibrium between democracies, governance, regulation, legislation, and the interests of businesses around the world. Because I'm a Canadian who grew up with Canadian Heritage Moments, CanCon music. I got to have Rain Maida on my podcast because I grew up listening to him, and I wouldn't in this current environment of 2023 because the Spotifys and the YouTubes of the world would never show me that content. I'm just wondering if you have any thoughts here or could speak at a high level to maybe the approach that you would like to see of how government gets involved with setting policy for things that happen on the internet, which feels very global, even though we fundamentally know it's not.
Yeah, I start off by saying I believe that government should stay out of business as a starting point. But then what happens is that's the philosophy that I start off with. But then you realize that the only people that believe that are Boy Scouts, because the rest of the world is not playing in that way. And that's what Jim found out very painfully when he was dealing with, say, Samsung, back when he was at BlackBerry. He thought he was competing against a company in South Korea and then figured out he was competing against the South Korean government. And the country in the world that does this almost better than anyone else is the United States. The country that talks about the separation of business and government, and yet they leverage government to fight their battles. And in a physical world, when you had, property, plant, equipment, supply chains, etc., you could at least get your hands around these issues and you could have this laissez-faire attitude to a large extent. In the digital world, the ability to make profit is written by the ink of a pen and gets changed by the same ink of the pen. So by its very construct, it's developed by governments around the world who tell you how much money that you could make off of the selling of your particular product and service. So the technology world should be the most savvy in working with government to ensure that their interests are aligned, and that when we're dealing with international jurisdictions, it's not you who is going to negotiate with another country. It's unfortunately, it's going to have to be our country with their country. Now, what is the problem? This is the problem that Senator Colin Deacon says. The problem is our folks in government, whether it's the political level or the bureaucratic level, have been very ill-equipped and ill-trained to understand that battle. And this is the problem for Canada. And if I had to just say what is one thing that we have to do, we have to retrain them. And we're trying. And by the way, it's happening very slowly, but not fast enough. Whereas China, as an example, wow, they've completely re-architected the way that they conduct their trade discussions. The United States the same way. Canada, we're still looking at the same techniques that we used in post-World War II. That is the fundamental problem. But you could either moan about it or you can do something about it and help our government in getting there. And I'll tell you, they are very open to hear it, but it doesn't take one time. It does take an ongoing concerted effort.
So you're saying you're running for election then?
Oh, hell. hell no. But I really respect what government does. I can criticize as much as the next person, but one thing I've learned is I don't criticize them unless I have a solution and an idea for them. So if you want to get engaged, and man, are they ever willing to. And what I'm really excited about is you saw this recent global hypergrowth program. And we're going to take these top 15 or 20 companies, and they're going to have this access. And these are folks who have said, yes, if I could only have access, I would ask for all these things. We're actually going to test this live. I hope it works. We don't know yet, but this is about to get launched very, very shortly.
So you're less worried than about a bad bill making things more difficult than our government not being able to engage at all?
Yeah, it's on the bad bill part, and there's a lot of aspects to it. Like, again, it's a stroke of a pen to get things changed and amended. I get worried where bills are created without engaging CEOs or other stakeholders at companies in which it actually impacts it. That's a real problem.
Let's end this on a little bit more of a positive note. This final question is coming from Canadian CEO, Jonathan Dunnett, CEO of Enable Leaders. He's wondering, what sectors or sector are you most excited about in Canada right now? I know we were talking a little bit about the earlier stage focus, that seed and A, being opportunistic from a pure investment lens. We were talking about AI a little bit from a regulatory standpoint. Just what are you looking at and just saying, here's a real opportunity for Canadian founders to do something?
Well, first of all, again, number one, I am very bullish on not only the technology sector as more classically defined, but I am also bullish on technology-enabled businesses, whereby these are, by all accounts, just traditional businesses. Their product or service is not a technology product or services, but they're leveraging the technology to make their businesses bigger, cheaper, faster. I have been very pleased with the rate of change of a lot of these companies, because they're realizing, if I don't change quicker, I'm going to be out of business. And some of the businesses that, or the sectors that we're looking at that we're continuing to be impressed with, is financial services, and I'd say in the broadest sense, when you include payments. Like, we have some of the best payments companies, particularly when they're related to SMB. SMB customers as a target market in the technology space, Canada is a great player, whether you're talking, of course, Shopify, but you got Clio, you got Jobber, you had Wave. You have a lot of high volume of high quality companies. Very exciting. I am intrigued by some of the players that we have in the generative AI space, whether it's at the foundational level of Cohere or at the application layer like an Ada. Some really good stuff going on. Blockchain, Canada is still, I'm a big believer in blockchain, still is. I'm so glad the cryptocurrency crap.
Yes, I was going to say, so you're actually talking about blockchain technology.
I'm talking blockchain. Blockchain, I'm still betting that this is a technology of the future. The other area that I do like a lot, and Canada's got some great advantages, is on quantum. We were the first institutional investor when I was at Omer's of Xanadu, as an example. So there are some good, deep technologies. But the thing that continues to keep it robust for me is the great university system we have here that are producing so much good talent. And that's going to continue happening. So I'm very bullish, and in terms of where to play from a stage perspective, I think it's going to be a barbell. Either you play at the seed, pre-seed level. If you're in the AB, you're going to be dead for the next few years. And at Maverix, we're playing really when you move out of the venture space and you're really moving into the private equity space, and we're in that transition growth period. But I think at those endpoints are going to be interesting. But in the middle, I think it's going to be continuing carnage for the next few years.
Well, that's a handful of things that we're going to have to keep track of, and then hopefully have you back to answer more questions. I got to say, while these were very thoughtful questions, they didn't seem as punitive as they normally are when we just do them without you. So listeners, this was duly noted. We're aware of how this went down. John, I can't thank you enough for coming on the record and having one of our text chats on the podcast. I think people are really going to enjoy this. There's a lot here.
Great. Well, thank you so much, Douglas. I appreciate it.
The BetaKit podcast is produced by BetaKit Incorporated. It's edited by Katie Lohr, and its hosts are Rob Kennedy and me, Douglas Saltis. To learn more about how you can support this podcast, head to patreon.com/BetaKit.